Good morning. How real estate investors scale without over leveraging themselves. And most investors don't fail because they lack an opportunity. They fail because they stack risk faster than they stack the cash flow. So if you want to build a serious rental portfolio, 5, 10, 20 plus doors, the key is pretty simple. Scale with structure, not with stress. And in Medallion Funds, we work with investors across Texas and nationwide who want to grow using disciplined underwriting and not speculation. And this guide breaks down how sophisticated investors scale using DSCR stacking and portfolio risk management, but also capital recycling. So, what does over leveraging actually mean? Well, over leveraging happens when you take out too much debt. But really, the point there is your debt service exceeds the safe cash flow margins, or your liquidity drops too low to relevant to the financing you have out there. But multiple loans could be adjusting at the same time, or one vacancy creates a chain reaction. So it's not about having debt, it's about having misaligned debt. And the goal isn't low leverage, it's controlled leverage. So let's look at option one, DSCR stacking, the right way to add more doors. So DSCR, or debt service coverage ratio loans, allow properties to qualify based on rental income instead of personal income. And why this matters for scaling is there's traditional financing caps based on your debt to income ratios and your personal tax returns and your personal W 2 income. Whereas DSCR loans focus on the property's cash flow and the rent roll strength and the debt coverage for the loan. So let's look at a smart DSCR stacking strategy. So instead of buying 5 properties in 1 year at the max loan to value, a disciplined investor may buy 1 to 2 properties, but make sure there's heavy cash flow, north of about 1.2, 1.25, based on whatever your payments are. And that way you have 6 to 12 months in reserves, and you try to stagger your loan maturities, and we can lock in fixed rates when possible. But scaling becomes repeatable in those situations, in those when you're set up like that. So number two is portfolio risk. Think like a bank. Serious investors manage their portfolio like a lender would. And here's some portfolio stress questions that you might want to ask yourself. So, whatever happens if rents drop 10% from where they're at now? Or what if we get hit with a vacancy in 2 months? Or what if insurance spikes, which that's a very real thing and it's happening. But do multiple loans balloon at once is another question. And most investors only analyze the next deal, whereas sophisticated investors are analyzing something more critical, and that's portfolio risk concentration. And that means diversifying your asset type. So more than SFR, duplexes, or small multifamilies, but a good spattering. And you need to maintain liquidity outside the portfolio, as well as monitoring your global debt coverage across everything. But scaling safely is going to require visibility, is the point. So let's look at capital recycling and how wealth compounds. And here's where most growth happens. And the recycling formula is pretty simple, but you acquire cash flow property, buy, stabilize rents, refinance, repeat, improve NOI. But yeah, really the point is once you get it performing, you can refinance and pull cash back out to get to the next one and redeploy into your next acquisition. So this is strategic refinancing and not cash out chaos. When structured correctly, your original capital keeps working, your cash flow improves, and risk doesn't spike. And this approach mirrors institutional investing models. So let's look at the biggest scaling mistake. So investors who are chasing appreciation rather than cash flow and ignoring their liquidity, or have multiple adjustable loans resetting at similar times, or if they forgot their exit strategy when it's time to get out. And the result is you could be forced into a sale during market corrections. Or scaling without over leveraging is going to require more conservative underwriting, some fixed rate discipline, liquidity buffers, make sure you have enough in reserves, but also timing your exits. So, who this strategy is for and who the model is going to work best for are really for long term buy and hold investors and 1 to 4 unit rental owners, but also small multifamily investors and self employed entrepreneurs who use DSCR loans, or just investors who are seeking blanket portfolio loans. Now, if your goal is 10 or more properties without financial stress, that approach matters, is the point. So, why work with a mortgage broker instead of a single bank? And scaling is requiring flexibility. And a single bank is really only going to be able to offer you limited options, their products. And they may cap your investor exposure or the number of transactions, but they often change their guidelines along the way, too. And a brokerage platform like Medallion Funds is going to provide you something different: access to over 600 plus lenders, DSCR programs, long term and short term rental, but also portfolio loan options. So there's refinance and capital recycling strategies, but also liquidity structuring. And scaling safely just requires lender diversity, and that's what we're here for. So the final thought is scale with discipline. And leverage is not your enemy, but misaligned leverage is. Say the investors who are going to win long term will underwrite more conservatively and refinance strategically and maintain reserves. But think about their portfolio as a portfolio level entity. And if you're serious about scaling rental properties the right way, let's structure it properly from the beginning. My name is Bill Rapp with Medallion Funds. You can visit my website, billrapponline.com. Love to talk to you more about your situation and to visit. Have a good day.